Well, this is Michael Douville coming to you from beautiful Phoenix, Arizona. It is Saturday, March 6th. Now, I'd like to continue the conversation we had from our Tuesday live webinar. We were talking about financing and what the difference is between owner financing and non-owner investor financing. Now, I hear this complaint all the time that we as investors are pretty good borrowers. We're really good buyers. Our credit is pristine. We're typically putting much more money down on a property than the owner occupant, 20% minimum. Oftentimes we're putting 25, 30, 35% down, yet we pay a higher cost. Now, that is just the cost of doing business. It is tax deductible, so at least we get that, but we are going to pay a slightly higher interest rate. So if the non-owner occupant can get a 3% interest rate, we're probably going to pay a 3.25. If they pay 1 point, we're probably going to pay 2. We're also going to pay the same appraisal fee, but also as an investor, we've got to pay the rental appraisal fee as well. So we get dinged for another one. And of course, no one likes this, but it's the cost of doing business. But let's think of this, because we here in the United States are absolutely spoiled, just spoiled. We have 5,000-year low interest rates, and we can lock them in for 30 years. 30 years you can take advantage of these rates. Now, they can't do that in Europe. They can't do that in Canada. They can't do that in Australia. But here in the United States, we're spoiled. All the bankers love these rates. They love us as investors because we're looking at 3-bedroom or 4-bedroom homes, 2-car garage, great neighborhoods, great transportation, great school districts, long-term. And they can always sell these loans in a secondary market. So they just love doing business with us. But we as investors have such a great advantage being here in the United States. Now, can you imagine that you can lock this in for 30 years, know what your cost of doing business is going to be for 30 years. You're going to know what that loan servicing is. There's, the taxes may move around a little bit. The insurance is going to move around a little bit, but the cost for your loan is not. So let me just go to this next slide. I want you to take a look at something and understand what we're talking about. Here in 1981-82 is when Paul Volcker came to power and broke the back of inflation in the United States. This is also 35 years up in interest rates and 35 years down, which would be textbook right on here, 2016. That is known as the 70-year interest rate cycle, 35 years up, 35 years down. Now you can see that this has dropped. We have some squiggles going up and down here over 35 years. And textbook would be 2016 drop. And of course, again, it's a bottoming process, and we've bottomed. And look where we are. Look where we are in interest rates. We are really literally at the lowest in recorded civilization for interest rates. And you can lock this in for 30 years. Now, we're certainly not going to take an adjustable rate mortgage at this juncture in the cycle. If you're looking at a 7-year cycle and we've just completed the down leg, well, interest rates are probably going to go up from here. So we want to be aware of that, which is why we haven't been talking about putting any money in the bond market. Bond does give you interest, but bonds have an inverse relationship to interest rates. So as interest rates go up, bond prices go down, and even a 1 or 2% rise in interest rates can devastate a bond portfolio. But you as a real estate investor, we can lock this in for 30 years. Now, one other caveat on this, we pay these back in cheaper dollars when inflation comes in. Now, a couple of weeks ago, we talked about 2005 bubble, but inflation adjusting it, we just now reached the height of the bubble that occurred in 2005, because cost of money has dropped. So we're paying significantly lower dollars than what we did in 2005. Our purchasing power has eroded 30%, and we've been in benign inflation. for the last couple of decades, virtually no inflation. Now, if you've been following my work, you know we're starting to talk about going into inflation. And even if we get kind of moderate inflation in 10 or 15 years, you might borrow 100% of the mortgage, but inflation may erode those dollars down where you're only paying back 50 or 60% of the loan. So it would be very, very good business to get these mortgages. The other side of the coin is you might consider consolidating. Now, me as a baby boomer, we are very, very risk averse. We have a tendency of not having any debt whatsoever. But when we start going into an inflationary period and we have such compelling interest rates, we might consider consolidating some of our debt. So if you have 5 or 6 properties that maybe have, $20,000 or $50,000, $60,000 in debt, you may choose one of those, put all the debt on one property, thereby kind of reducing your risk and putting all the encumbrance risk on one property and taking out these new loans at this interest rates. Now, what will also happen is that you'll get rid of all those old mortgages, and you're probably going to get a much, much higher monthly income because they're going to be casting the debt at a much lower rate. And we're more than happy to talk with you about that. So let me just go to the next slide. You know that we're here, always available for you. If you'd like to reach me, you can reach me at creatingwealth@westusa.com, Michael Douville or michael@michaeldeville.com. And we can discuss this with you. If you want to do any of this and get involved with us, we're more than happy to do that. If you want to make any of these moves, I would certainly talk to your spouse or your partner, talk to your financial advisor. We're here. You can brainstorm with us. We're more than happy to do the calculations, see if any refinance will work for you. And if we can help in any way at all, we're here to help you. Just give us a call and we will absolutely help you any way we possibly can. So my very, very best to you. God bless you. Bye-bye.